Hey everyone, my name's Andy. My channel is Finding Value. If you like making money, it's just that easy. You just click subscribe. It's in one of these buttons or something down there. If you are interested in the best investment opportunities that I can find in the world, just click subscribe. So today I'm going to go over commodity companies. I'm looking at risk, reward, and where some of these commodity companies are in we'll call it like a development stage versus a production stage. And we'll go over those stages of where these companies are at and show you visually. That's what this presentation is about. I'm going to talk about risk and why some of you put a lot of exploration companies. And I know that they can pan out very well, but a lot of them don't pan out very well. So just want to make sure that you guys understand all of the risks and where I'm kind of putting my money. These are the commodity companies that I'm going to cover. This is allocation, portfolio allocation to mining companies. I just want to ensure everyone knows my stance on the commodity companies, how I allocate my money into the companies, and where I reduce my portfolio exposure. So, diversified miners. These are the lowest risk of all of the mining companies. I hold a good chunk in the diversified mining companies as they have many projects and mines across a spectrum of different minerals. These carry the lowest risk as they have many projects and are across many commodity minerals. That's what creates that low risk. I hold a good chunk in these as they are lower risk. Some still have very good potential to increase in value. They can go 10, 20, 30x. So overall, they do have a lower return compared to the other smaller companies. That is true. These are probably the closest to, quote, the surest bet. I'm not saying that they're sure bets, but they're as close as you can get. For a commodity bull market, the diversified miners will most likely follow the commodities higher with some leverage to it. So these are what I consider to be the surest bet. And you can also do certain things even with diversified mining companies. You can say, I like nickel and copper. So you look at the diversified mining companies that mine copper and nickel. You look at the previous bull markets, nickel and copper went up pretty well during the last bull market. So those would be pretty good areas or sectors to look into. Then you take your diversified mining companies, you look at their cost curves, and the ones that are the highest cost producers will most likely have the most leverage to the price. So one way that you could almost reduce risk while maximizing leverage would be to pick the sectors that have the highest leverage. I think copper and nickel are two good sectors, right? And tin. Pick a diversified mining company that covers those sectors, and then find a high-cost producer. And that is a diversified mining company. And you might have a very good leveraged play there with pretty low risk. Now, other mining companies, they are just producing, but they're not diversified. So they are lower risk, but they are stuck to one sector. These mining companies that I'm talking about are more focused to one sector. They can have multiple mines and are pretty good at capturing the minerals move, that sector's move. These are, quote, pure plays. These have lower risk but are subject to the commodities price swings. And that's exactly what we want in some of our investments. I like these companies for the direct exposure to a commodity that I want exposure to. It is that simple. So if you want high silver exposure, pick a company that has multiple mines, which would be a lower risk play against as pure as you can get commodity. So if you want a silver company, something like a First Majestic Silver might be a pretty good bet, or Endeavor Silver. I think there's some other ones. I'd have to remember what has the most silver production. I think it's about 40% or 50% of silver. It's about as high as you can get, but those are the most direct ways to play it. And you can find small copper companies that may be producing, that might also be a pretty good play for that sector. And here's mining companies. These are medium risk. And really the difference between the last one is they only have a single mine that's producing. All of their chips are in one mine, and the problems that could happen with that one mine increases risk. Jurisdictions can also be a problem with some companies if they only have one mine in a bad location, or they have multiple mines all in the same country. Taxes, nationalization, whatever it may be with that country could have problems, an electricity outage, whatever it is. Doesn't matter. The risk goes up if you're concentrated into one country and you're concentrated in only one mine. So developers, they're getting into high risk. These are companies with a single project or more, but do not produce anything. These are in the development phase of a mine and may or may not need money to finance the completion of the mine. And that is some of your risk, is the financing. These are higher risks as they need money. They don't have money. They can have lots of share dilutions. And again, they have a mine that they're going to develop. So they have mine development risks with the project. So there's all of those things that can happen. There's delays, there's problems, and maybe a company is developing a mine. They think it's going to be developed for this commodity bull market, and the mine doesn't get developed in time for the commodity bull market. That is a risk. It could be a high risk. And then we've got explorers. This is like the ultra high risk. These are companies that are looking for deposits, but may not have anything or found something that they are trying to still expand their resource. So they may have found something, but they're still trying to expand the resource or reserves, or there's ones that they don't have anything yet. They're still looking. These companies have the highest risk and most of the time the highest reward, as they are priced like they do not have any deposits. I mean, if they don't have one, they're priced like it. And then all of a sudden they may strike something very large. And then once it gets proved up, it could be a very large deposit, which could return many hundreds of times of returns, depending on where you bought it. But they are the most risky because they may not find anything. You may be stuck investing in companies that never find anything during a great commodity bull market and be left behind. So whatever you choose, make sure the companies you are choosing offer leverage to the commodity itself. If you do not get much leverage, I often rather choose to invest in physical precious metals as it's much lower risk above any of the options above. And just because something has more risk does not mean it automatically offers more leverage. Because it has more risk doesn't mean it offers more leverage. We do not want those companies that have high risk and not much leverage. We want to skip over those. We are looking for anomalies in risk reward if we can find them. And what I mean by that is some of these got sold off so much in the COVID crash, something like an SM Energy or Centennial Development and all these other ones where they carried debt and they were sold off to 1% of their original valuation, of their original all-time high. That is extreme value. Extreme value. And if oil does very well, or when it does very well, we could see many multiples of returns on those companies because they have everything in place in terms of production. They have debt problems per se, not really problems, but they have a lot of debt, and they were far oversold during the bear market. And remember, energy is the biggest inflation hedge against a declining dollar. So if they carry debt, that may be a good thing when the inflation component of oil really starts to kick in gear and they can pay that debt off very easily. Just something to keep in mind. So the life cycle of a mineral discovery, I'm just going to cover this very briefly. The exploration companies are in this stage right here, and we are speculating on them, hopefully finding something. So this is the big move if they find something, is this initial gigantic move where they discover a deposit. So we're speculating, we've got initial drill results. There's a tipping point in exploration when drilling amounts to a real mineral discovery and excitement is at its peak. At some point, the peak will happen. Everyone rushes in. We have everything proved up, and it's a very large deposit. And between this discovery and an operating mine, there is a large sell-off. It's called the orphan period. That orphan period, after the initial excitement, proven discoveries require large amounts of capital for construction, but are not yet receiving cash flows from an operating mine. That excitement wears off and people sell the stock. So we get this nice big surge up, we get a nice sell-off, and then eventually what happens is At the bottom of that sell-off, it's usually a few years after the excitement, the feasibility development stage here. We get another excitement period where they're building and developing a mine, and the stock runs up before it starts producing. So we get these two big run-ups, the speculative exploration discovery find, and then we have the development phase. So I like buying companies here and here for those high risk, high reward opportunities. The uranium sector, there's a bunch of companies here and there's a bunch of companies right here. So it's a very good opportunity with uranium being so leveraged to the price of gold. So that's that. So there's different types of situations. Developers are usually a good spot and explorers for huge outsized returns. Companies that are high producers with some debt typically get demolished to the downside before a commodity boom. The oil companies get slaughtered. They just got slaughtered this past bear market in oil. So I found and invested in a lot of oil companies. Uranium is in a similar situation as oil. And I think opportunities in this sector are tremendous, and they still are right now. So that's a spot that I think is incredibly good to look at. So when to go for it, and what does this mean? This is when you go for it. You want to go with higher risk companies when the risk is the lowest, when the valuations are beaten out of it and the money's flowed out of the sector. That is usually when the ratios are cheap, markets hate the sector, and the money is flowed out of that sector. So what we're doing and what I'm doing on this channel is I'm looking for bottoming patterns on the charts and look for other sectors to be turning up that are similar, basically other commodities, because they're all somewhat tied together and they also are tied to a declining dollar. This is when I hit the high risk button to gain outsized returns. That's when I hit it. Uranium is the spot where I'm looking for these returns right now, and the number of companies are not really that many. So I'm looking at all those companies. I'm spreading my money out amongst all of them. So my favorite companies, I overweight based off of risk reward, ratios, and value of the specific company itself. I tend to favor higher cost curve companies while prices are down and are about to go up and may have some debt, and it doesn't scare me away. They have producing assets, but the timing is what is scaring people. The timing being that the price is low and there's a lot of fear in the market. Once prices come back, they tend to rocket higher because they have everything in place to produce from mines or wells to increase cash flow at ludicrous amounts. They go from they're losing money with a very low price to a multiple of its profits going from a negative to a very large number. That is what your earnings per share is going to show, is that increasing profit. And higher cost producers have greater multiples of their profits going up in an increasing price environment. And if we get inflation in commodities, they're going to go higher, reducing debt levels of high debt companies. That's something just to keep in mind. And the conclusion here is I look for ratios for value, market conditions and charts for timing, and then I invest. I allocate capital based off of risk reward and look for anomalies in value compared to history. We still have incredible opportunities in the market right now, and don't feel like you've missed out on anything. All of these things, they're just starting to come out of their bottoms. Some have come up. I would say precious metals are probably the most developed of them all. And copper. Copper's up, I'm going to say, has moved up quite a bit, but nickel's still down. Some of these other ones just broke out of patterns like iron ore. Oil is still working on breaking out, and uranium hasn't really even moved much yet. So we still have a bunch of great opportunities in front of us. If you're interested in those opportunities, I do lots of videos on all of these things. Click subscribe to the channel, join this community. If you have picks, put them in the comments section. Let me know what you like. We can all look at it. We can give you our opinions on this community, and we can help everyone kill it in this next commodity boom. If you guys like this content, give me a thumbs up, and thank you for listening. This is Finding Value.